strategies, didn't take long for me to think of the most popular strategy out there in the world, whether you're talking about stocks, futures, Forex, any asset class out there. It always seems that by far the most popular strategy when it comes to entering into positions is breakouts. It's also ironic that you hardly ever meet anybody that actually makes a consistent living trading breakouts. In fact, most people end up losing trading breakouts. So why is it that trading breakouts are so popular, yet you don't see people being successful with them? That question is really what we're going to dive into today, and I think you'll see at the end, the answer is really that breakouts are great, but what we're going to do by the end of the presentation is really hopefully shift your thought process just a little bit from a conventional breakout mindset to a more real-world trading mindset that'll help you become hopefully very successful at actually trading breakouts. And as we get into the material here, not that I like to talk about myself, because I don't, but I think it's important that you hear a little bit about my background because it 100% applies to what we're going to be talking about today. I started my career on the floor of the Chicago Mercantile Exchange many, many years ago, handling institutional order flow, taking orders in the morning from banks, institutions, money managers, hedge funds, retail traders, you name it. We took some pretty big orders, and I would answer the phone early in the morning. I'd be on a trade desk right outside the trading pits, and I would take these orders as fast as you can imagine, buy and sell orders in the various markets. And a few minutes before the U.S. equity market was about to get going, I would stop answering the phone, and I would do that because I had this giant pile of orders right in front of me, buy and sell orders. And I would organize those orders. I'd take those few minutes to really organize those orders, stacking them in piles, putting the buy orders to my left and the sell orders to my right. And I would actually stack them according to price. That's what you did. Okay. I'd glance up at the market and see where the market price was. And any of these orders that were close to market price, we would take them down and put them into the pit. But the most important part of this is, if I wanted to know where prices in that market were going to stop falling and begin to turn higher, all I would have to do is look down and to my left and find the largest stack of buy orders. And that was probably going to be, the floor for that morning, that day, maybe even that week, depending on how big it was. If I wanted to know where the market was going to stop rallying and begin to turn lower, I would simply have to look down and to my right and find the largest stack of sell orders. This was real, pure supply and demand in these markets. Nothing related to news or opinions or indicators, oscillators, or anything. These were real buy and sell orders into these markets. And so from my perspective, I didn't start out trading reading a book written about lagging indicators or oscillators or conventional this or conventional that. I just saw real order flow, and it wasn't rocket science how this stuff worked. This was all just motion into mass, the mass being the big stacks of orders. Okay. Now, there's a reason why I told you that story, because as we go on, I'm gonna challenge you right away to, as we look at charts, instead of looking, say, at candles, we're going to look at candlestick charts, but instead of just looking at charts from a conventional sense and recognizing your conventional chart patterns and all the information that a red candle and a green candle give you, let's take things a little bit deeper and start to understand the order flow that's going on behind the scenes that's actually responsible for the creation of these candles. I run an extended learning track, which is a virtual trading room at Online Trading Academy, and these are some of the things we talk about regularly. I pulled a nice chunk of a lesson out of there to share it with you here today. These are two very important questions. What we're diving into now is what we need to do before we get into breakouts. It's not going to take long, but instead of jumping in and saying, hey, I want to trade breakouts, it's never going to work if you don't have a solid understanding of how a market really works. How and why do market prices change direction, things like that. So let's take a few minutes and dive into that. Keep the floor trading example in your mind as we talk about this, and I think that'll help. We're going to talk about two specific things here first. Number one, where and why do market prices change? Okay, you have to understand, as I said a few minutes ago, prices, this is all, the movement of price in any market is simply a function of an ongoing supply and demand equation. Okay, and as I say here, prices in any market turn at price levels where demand and supply are most out of balance. Okay, now you might say, Sam, that's great, but how does this help me? I'm never going to be on a trading floor, and I'm not going to be a market maker, so I'm not going to see the orders. Don't worry about that. The good news is I'm going to show you exactly what this picture looks like on a price chart. Okay? Again, those big stacks of orders, those were price levels where supply and demand was so out of balance. When price got to those levels, it stopped and changed direction very quick because it had to. We're going to see that on the charts in a few minutes. Why is number one so important? This point number one here is important because if you want to obtain low risk, high reward, and high probability entries into markets, trading opportunities, the only way you can do it is to consistently identify turning points. If you can't consistently identify turning points in a market, okay, based on an objective set of rules and criteria, you're going to have it's going to be impossible to take low risk, high reward, and high probability entries. So we're going to talk about that. It's very important when we talk about breakouts. Number two, the second piece of crucial information you need to understand is this. Who is on the other side of your trade? Understand that when you push the button and place a trade or a day trade, a swing trade, a longer term investment, there is somebody on the other side of your trade trying to take your money. Okay, you have to understand who that is. Okay, understand, and let me tell you, being on a trading floor, you see this firsthand. The trading is simply a transfer of accounts from the people who don't know what they're doing into the accounts of those who do. Okay, the consistently profitable market speculator makes sure that there is a consistent losing trader on the other side of their trade. Again, you're probably thinking, well, we're looking at charts. You don't know who's on the other side of your trade. Well, yeah, you don't know their name or where they live or anything like that, but whether they are a consistently profitable trader or a consistent losing trader, we can tell that by looking at the chart. I'm going to show you exactly what that novice trader looks like on a chart. Okay, let's move on here. Let's start to put those words into a picture here, and let's again start to see the order flow that's going on behind the scenes that's responsible for the creation of these candles. Let's hit these two important points up here, and then we can dive in and understand how to trade breakouts properly. Let's focus on this area right here. I can show you that with a pointer here. There we go. So we're going to focus on this area right here. Notice that the candles are trading sideways here. Price is not moving much. Supply and demand appears to be in balance. But all of a sudden, we get a strong drop in price, okay? A breakout or breakdown, okay? Instead of entering on this breakdown, all right, we want to let this happen because once it does, what this information tells us is that we have a big supply and demand imbalance up here at the origin of that breakout. Again, prices were trading sideways. All of a sudden, you have a strong drop. Understand that this drop can only happen because there is so much more supply than demand up here in this cluster of trading. Okay? So when prices fall, this is when we can say, aha, we now know where that large stack of sellers are. Okay? And if that, I keep saying supply exceeds demand up here, if that statement was not true, this drop in price never would have happened. Prices would still be trading sideways. Okay? But it had to happen. And your job at this point is to understand why. And that's what I'm trying to explain to you. Prices drop as they do, and all of a sudden down here, again, supply and demand appears to be in balance because prices are trading sideways. The truth is, behind the scenes, it never is. It's always an unbalanced equation that simply takes a certain period of time to play out. And all of a sudden, we have a rally in price here, okay? So understand that this rally, the only reason why this rally happens is because demand exceeds supply down here at this cluster of trading at the origin of the rally. We can look at the news and all that other stuff, but that stuff comes in after the fact. The fact is, Prices had to rally from here because demand exceeds supply down here. Now you see these lines I've wrapped around this level. In the program that I run, what we do is we very mechanically wrap these lines around these levels. It's a very rule-based way that we do it. So once prices fall from this level, we wrap a couple lines around this level, creating a supply zone or sell zone, resistance zone, whatever you want to call it, and we carry that level forward. Same thing down here. Once we have a demand level, meaning once prices break out of this area, we then wrap a couple lines around this level, creating a zone going forward, just like in the article, and we carry that level forward because we want to remember where the real demand and supply is, where those real stack of buy and sell orders are, okay? So that takes care of step one here. Where and why do market prices change direction? We've identified a couple market turning points, in other words. Step number two, who is buying and selling? Who is on the other side of your trade? Let's focus right up here, okay? Who's buying here? Now, if we specifically focus on the buyers here, we can conclude that they are novice market speculators, novice buyers. How do we know that? Well, they're making the same two mistakes that every consistent losing trader makes, okay? Mistake number one, they are buying after a rally in price. Not a smart thing to do when you're buying and selling anything, let alone trading. Mistake number two, they're buying right into a price level where objectively the chart tells you supply exceeds demand, okay? So mistake number one, buying after a rally in price. Mistake number two, buying into a price level where supply exceeds demand. We want to sell to those novice buyers, selling short right here at the bottom of the area with a protected buy stop just above the level. Okay. Of course, there's a little more to it. We want to make sure that we have a profit margin, a significant profit margin associated with the supply level, but we'll get to that in a little bit. Down here at the bottom, if we focus specifically on the sellers here, okay, again, we identify novice sellers coming into the market, making those same two mistakes. Mistake number one, they're selling after a drop in price. Mistake number two, they're selling right into a price level where demand exceeds supply. The laws of supply and demand guarantee that the sellers down here, that strategy, are going to lose consistently over time, okay? They may be right once in a while, just like up here. Once in a while, you may buy into resistance after a rally in price, and it may keep going for a little bit for you. But it's only once in a while, and be assured that in trading, money always ends up in the hands of its rightful owners, usually pretty quick. Okay? So the two keys here in understanding how markets really work are, number one, identifying your potential market turning points based on the real supply and demand in a market, and number two, understanding and being able to identify when the novice trader is coming into the market, the person we always want on the other side of our trade. Okay, let's move on. Won't spend too much time on this one because we just talked about this, but just more of a picture. Again, you want to become proficient in identifying someone making these two mistakes. Again, mistake number one, someone selling after a drop in price. Mistake number two, selling right into a price level where the chart has already told you demand exceeds supply. That's why this rally happens. Okay. Now, you may be thinking, well, this makes sense. This seems logical. I understand. And I will tell you, this is not rocket science. Okay. All I'm saying is, look, the way that you buy and sell things in other parts of your life, bring that mentality to the trading world, okay? Because for some reason, everybody throws all kinds of logic out the window when they come to trading. We'll get back to that in a little bit, all right? So the challenging part to what we're talking about is actually doing it, all right? Because doing what I'm suggesting here, what I suggest in the article, while it may sound simple and look simple, actually doing it will challenge every emotional bone in your body. Why? Because we're looking to buy after a period of selling, which is usually accompanied by nasty red candles, which is almost always accompanied by bad news and downsloping indicators and oscillators. All these things coming at you telling you to sell. Okay? We'll get back to that in a little bit as well. Let's get into breakouts now. Okay, what I wanted to do there was really help build a little bit of the foundation of understanding how markets really work. okay? It's all a matter of the order flow. It's a simple equation of buyers versus sellers, right? Let's talk about buying breakouts, all right? Let's look at this example on the left. This is your typical breakout. Prices may drop, you get a little bit of basing sideways, and all of a sudden prices start to rally up, whatever market we're talking about. We're going to look at real charts here in a few minutes. This breakout here, okay, a lot of people will look to buy this. Now, there's two problems with that. Number one, you only know it's a breakout after it happens. So that means it's at this, you're buying after a move in price. You're cutting into your reward profit target. So that's going to be lower reward. Buying after a move is underway already means that you're buying further and further away from your protective sell stop, which is going to be below the level. So that means higher risk, okay? And because most breakouts usually come back pretty quick and retest the area, okay, that makes it a very low probability trade. So while breakouts look nice and they're easy to see in hindsight, the truth is, in reality, this is not a low risk, high reward, and high probability way to enter a market. Instead, why not sit back, let this happen, because once it does, this gives you all the information you need for a low risk, high probability, and high reward trade around the corner. Okay? Again, how prices leave this level, the fact that they rally up strong from this level tells us that there's a big supply and demand imbalance down here at the origin of the breakout. Therefore, if you understand that, then you're going to be very excited to buy when prices revisit that level. So instead of just buying the breakout, it's a lot lower risk, much higher reward, and much higher probability to wait and buy the pullback, okay? Because here's the thing, until prices leave the level, how do you know demand exceeds supply there? Prices could just as easily drop from here. Why not let the market tell you exactly where the real buyers and sellers are? Let the order flow and more importantly, the imbalance of order flow tell you where the real buyers and sellers are. So when prices break out here, we let that happen, and when prices come back into this level, I am very comfortable buying here for two reasons, okay? Three reasons. Number one, I already know that there's likely to be more demand than supply here. That's why prices rallied out. So it's a higher probability trade. Number two, buying right in here at this top white line, okay, I know that I am far from my target versus buying up here on a breakout, okay, so the reward is pretty good. And last but not least, in fact most important, buying right here and putting my protective sell stop just below the area means the trade is low risk, okay, and that's what we're looking for, all right? So big difference there between the two. And again, just understand that true demand is within the range of the cluster of price action, okay? And it always begins at the origin of that breakout. That's the area we want to focus on. On the short side, we'll go through this a little bit quicker, okay? So again, here's your typical standard breakout. Prices are just trading sideways, and then all of a sudden there's a drop in price, okay? Instead of trying to jump on this and sell when everybody else is selling, right, that herd mentality type trading, okay, let this happen. There's a lot of things we want to see here. We want to see, look, did prices fall from this level in strong fashion, suggesting big supply and demand imbalance here? Or was it more of a gradual drop away from this level, suggesting maybe not such a big supply and demand imbalance here? How far did prices go once they broke out? In other words, how big is our initial profit margin? There's a lot of information we get from this initial breakout that gives us a low risk, high reward, and high probability trade when prices pull back into the level. It's a completely different trade selling short up here versus selling short somewhere down here after the drop is underway, okay? Now, we don't just want to sell short at any breakout. We want to make sure that the supply level, we'll call this a supply level, is a specific pattern that we look for. Rally, base, drop. Just like on the prior example, we want to look for drop, base, rally. Notice I put the word pivot low here. Okay. Whoops, sorry about that. And then I put the word pivot high here. Okay. We don't want to, in other words, there's a difference between a drop-based drop and a rally-based drop. We are more interested in the rally-based drop, selling a pullback in price to that level, because the rally-based drop forces us to trade out at the extremes, and that's what we want to do. Let's take a look here at some examples. Okay, let's really walk through. Again, let's take this a little bit deeper here and understand what's really happening. So here we have our pattern: drop, base, rally. Okay, not rally-based rally, but drop-based rally. That's what we're looking for. Okay. One of the things we want to look for, we want to let this happen. Again, the standard breakout is to just buy into this green candle. Here's your breakout. Okay, we don't want to do that. We want to be the astute market player and not trade with the herd, but trade with the smart money. Okay, so instead of buying the breakout here, let this breakout happen. This breakout gives us a lot of information. Let's dive into that information. Number one, was this a strong breakout or a weak breakout? Well, it's a breakout with a gap. A gap represents the ultimate supply and demand imbalance. In other words, supply and demand was so out of balance down here at the origin of the gap that you didn't even get any trading in here. Price had to gap away from this level. Okay? So that gives us a lot of information. That means we really want to remember this level. We definitely want to wrap our two lines around this level, creating our demand zone, and carry that forward. Okay? Number two, how far did this rally go on this initial breakout? Okay, because whether we want to take or trade here or not depends on how big of a profit margin we have, which we're going to get into in just a minute. But notice when prices rally up, okay, the highest high here is above this cluster of activity here, okay, meaning that there's obviously some supply here. This is a rally-based drop, supply level, but notice that this rally trades eventually through it, meaning that, it does fall here, but the truth is the initial breakout buyers here do all the dirty work for us being the people that want to buy the first pullback. What do I mean by that? I mean that these guys absorbed all of the significant supply here. It's like the snowplow effect. The snowplow comes in and pushes away all the sellers, gets rid of all the sellers. The buyers absorb all the significant supply left here, so that when prices come back down here for our low risk, high reward, and high probability entry, there's nothing here to stop prices from rallying pretty strong, at least up through here. Okay, so let this initial breakout remove all the significant supply to the left, absorb it. In other words, that's what's really happening, and just sit back and say, you know what? I'm not going to jump on with the herd here. I'm going to sit back and take maybe more of the Warren Buffett approach, right? Buying things when they're on sale at price levels where they're about to turn higher. I'm just showing you exactly what that looks like on a price chart based on real supply and demand. Okay? When prices come down to this level, typically in our group, we buy right at this line here with a protective sell stop just below the level. And our first profit target, we might have time to get into that later, but we certainly that's certainly another important point of this. Okay. All right. Now, but that's part of it. The last part of this equation here is, remember, don't forget that point number two. Who is on the other side of your trade? And think about it down here. And let's only talk about things that we know to be true. If we're going to buy down here, who are we buying from? Who are the sellers? Well, the sellers down here we see are making those same two mistakes that every consistent losing trader makes. Mistake number one, they're selling after a drop in price. Mistake number two, they're selling right into a price level where demand exceeds supply. A consistently profitable trader would never do that. They would never sell down there after a drop in price and into that demand level. How do I know that? Because they wouldn't be consistently profitable if they did. They couldn't be. Okay? So we want to recognize that someone is coming in the market here that doesn't know what they're doing, and we want to buy from that novice seller. Very low risk, because even if we're wrong, which we are sometimes, not every trade is a winning trade. we have to focus on the risk. That is the most important part of the trade. Okay. Just the opposite here. Here we have our supply level and our breakout or breakdown to the downside. Rally-based breakout or breakdown to the downside. This is the breakout or breakdown that most novice traders take. This is the breakout you see that's in all the books, telling you when prices break below this low, get shorts. Okay, just because the books say it so, doesn't mean it's the best thing to do. Instead, why not let this breakdown happen? Sit back and watch it and say, aha, I now know where all the sellers are. Because the only thing that causes prices to drop like this is the fact that there's more supply than demand at the origin of that drop up in here. Therefore, if and when prices rally back up to this level, someone is buying after a rally in price right into a price level where supply exceeds demand, I'll sell to that buyer anytime I see them. Okay? It's such a subtle difference between selling here and selling here, but it's a subtle difference. But if you can make that minor shift in your thought process, it's likely to have a monumental impact on your trading results. Okay? Because the thing is, most novice traders that sell short on this breakout here, where do you think they put their stop? They all put it right up here. So, and this is what it hits them. Just as they're about to stop out of their trade for a loss right here, that's when it hits them. They say, oh my God, I put my stop exactly where I should have been getting it in the first place. If you have a pattern of getting stopped out of your trades and then they go in your favor, you're likely making the mistakes that we're talking about here. Okay. All right. Let's take this a step further and let's talk about profit margin. It's something we focus on a lot. Okay. Profit margin does a lot more than just tell us what our potential profit is. It also helps assess the probability of the trade. Let's talk about why. Okay. The bigger the profit margin, okay, that means the further out at the extremes you're entering your trades. So here we have a level. We have a strong rally, little base, and then a drop in price. Again, this drop in price can only occur because there's actually more supply than demand up here at the origin of that drop. So we want to recognize that level, very mechanically wrap our two lines around it, creating this zone. Okay. Now, just because prices rally up to this level doesn't mean we want to sell short. Is a novice buyer buying here? Probably, but that's not enough reason. We want to make sure that we have a significant profit margin to the downside. Okay. When we look at this circled area here, we see that there are just a bunch of big green candles. In other words, there's no pockets of demand. There are no pockets of demand inside here to stop prices from falling, and that's why they fall. Almost every day when we're in our trading room, I'm putting a big circle like this on some chart, identifying big pockets of nothing for our traders, and that is strictly to show what the profit margin is. The origin of this big rally is down here, so I'm fairly certain there's demand down here. That's why prices couldn't stay there, right? Okay. So the fact that we have our supply level rally-based drop, and remember, here's that initial breakout. Again, like the article suggested, instead of selling short here, let this happen. This gives you all the information you need for a low-risk shorting opportunity right around the corner. Okay? But again, we only want to take this trade if we know that we have a significant profit margin below. If the risk is maybe at least like a third or of the potential reward to the first target, for me that's enough. Okay? Hopefully the trade goes well beyond that, but I like at least 3-to-1 to my first target. Okay, let's take a look here. Why don't? What's another reason why breakouts don't work? Well, this is the most common reason. It's a lack of a profit margin. That's the answer. Okay, I don't care how strong and ferocious and news-driven the breakout is. If there's no profit margin, the trade is not likely to work. So notice here, prices are trading sideways. All of a sudden, you get this green candle that takes out the high. Prices start to break out of this area. A lot of people are going to jump on with that herd mentality. all the indicators are going to start giving you buy signals here, and boom, prices just explode out of that area. But guess what? They're breaking out right into a price level where the chart has already told you supply greatly exceeds demand. Okay, so while all the novice kind of book reading traders are buying that breakout, what they don't realize is they're buying right into an area where supply greatly exceeds demand, and most of the time price is going to hit that level and collapse in the other direction, because now the novice trader is trapped on the wrong side of the market, and that usually creates a big move in the opposite direction. I used to see that example live on a trading floor every single day. Remember I said I had those large stacks of buy and sell orders in front of me. Well, every time prices would get into those levels, for example, the big stack of sellers, a big stack of sell orders, the phone would ring, and it would be retail traders wanting to buy. And trust me, they wanted to buy in the worst way. A rally had just been underway, prices were going up, good news was starting to come in, and all of a sudden we're getting to this this giant stack of sell orders that I had in front of me, and the retail people are calling up and buying and buying and buying. They did not have a chance to be profitable in those trades because they were buying right into a brick wall of sellers. This is just what that picture looks like on a price chart. So let's do just a quick little review here, okay? And run through a little checklist, okay? Number one, identify a strong move in price from a pivot high or low. Notice I underlined the word strong. Why do we want to identify a strong move in price from a pivot high or low? Well, because the stronger the move away from an area, the more out of balance supply and demand is at the origin of that move. Okay? We want to look for pivot lows or pivot highs, not clusters of activity in the middle of moves. Okay, and that's because we want to trade out at the extremes. There is, the majority of trading and volume is always at equilibrium, but that's not where we want to look to trade. We want to trade out at the extremes. We want to look inside these pivot highs and pivot lows and find these little rally-based drops and drop-based rallies and so on. Okay, this represents a price level where a major supply and demand balance exists. And again, as I keep saying, in other words, this helps us assess probability. Number two, identify the origin of the strong move in price. That's exactly where the imbalance is, and that's where we want to draw our lines. Number three, determine your profit margin. We've just done that, and this objectively determines our risk reward. The profit margin is the distance between our fresh, key word there, fresh demand and supply levels. Okay. Number four, plan the entire trade. This helps you take the emotion out of the trade, and people talk about risk to trading being gaps and all kinds of other things as those are all risks to your trading. But honestly, the biggest risk to trading is you and I as human beings. So the more we can take ourselves out of the equation and pre-plan our trades, our day trades, our swing trades, our longer-term position trades, the better. And as I've always said, keep it simple. One thing I haven't said yet is I've written a number of articles for SFO magazine, and one of them, they're all kept pretty simple, but one of them I think is titled actually Keep It Simple. You can always go back and review some of those. They're found on the SFO website.
Okay, thank you. Oh, Sam, do you have more?
Yeah, just a couple quick ones here, and then we'll wrap up here. What I thought I'd do too is instead of me telling you all this and telling you about my trading and stuff, which we could do, I thought it'd be more important to show you what people like yourselves that are learning and desiring to become successful market speculators are doing. What I do is I just cut and paste a couple emails right out of my email for you here, and just to show you. Then I attach a chart from the these are people that are a couple people in our program that are doing pretty well. First one says, thanks for the QQQQ trade idea. That's the NASDAQ ETF. I marked my Q chart with a zone when you noted on your conference call. That's the trading room. I bought 2,000 shares of QLD at 35 yesterday. Thanks again. The next day, sends an email. I sold 1,000 shares at $36.50 for a $1,500 profit. Sold the 1,000 shares today at $37.40 for a $2,400 profit. Why did he do that? Notice right here, let me point this out to you here. I'll give you a little example here. This is his trade, okay? Notice right here, prices are basing sideways, and all of a sudden you get this big breakout. Most people want to jump on this breakout, but the truth is, by the time you know it's a breakout, you are buying so late, it becomes a very high risk, very low reward, and honestly, most of the time, a very low probability trade. So instead of doing that, what Tony did was he looked at this, but he didn't jump on board. Instead, he said, wow, look at this rally. There must be a huge demand level right here, a huge supply and demand level here. So he wrapped his lines around that level, carried it forward. When prices came back into this level, again, focusing on step number 2, he saw that someone was selling after a drop in price and right into a price level where demand exceeds supply. Buying here is very low risk. It's the first pullback. It's low risk because you're entering the market very close to your protective stop, and using the proper position size, it's a very low risk trade. If you're wrong, it's not a big deal. Very high reward because you're entering farthest from your target, which is right up here, the origin of the last drop in price, and it's a very high probability trade because you're entering where the real buyers are. And on that note, I've got a ton more of these, but I think you get the point from here. So the whole point here is to not think like everybody else thinks, not just take a trading strategy because people talk about it and all the time, but simply just step back and say, wait a second, how does a smart buyer and seller of anything operate? And bring that same logic into the trading markets. And with that, I'll turn it back over to Heather here.
Okay, we have a number of questions, so I encourage attendees to stay on for just a little while longer while Sam answers them for you. We have a number of questions about time periods and how this approach works with what kind of time period, and is that any different for different markets such as Forex?
Yeah, great question. And I always make sure, if you go back and read any of the articles in SFO that I've written, they are all, including what we talked about today, applicable in any asset class, stocks, futures, Forex, options, and this is all applicable in any time frame. This is not time frame specific. This is not market specific. So just be sure you understand that.
There was one specific question about for intraday trading, wanting to know which time frame chart gives the clearest indication of supply and demand. Is there a difference?
Again, a time frame question there. If you're a day trader, you're going to stick to the smaller time frames. If you're a larger time frame, a longer term trader or swing trader, you're going to stick to the larger time frames. But the only reason why you would switch time frames to get a better look at the supply and demand levels is, let's say you find a level maybe on an hourly chart, but maybe you're trading a stock and that level is 50 cents wide, and maybe you don't want a 50-cent stop. You can always go down to a smaller time frame and look at that same level, and you'll probably be able to tighten it up. So the only reason why you do it is to go to a smaller time frame to maybe reduce the risk a little bit. But it's not that you're going to get a clearer picture. You want to keep this stuff pretty much time frame specific, relative.
Okay. Moving on to some other questions here. We have so many. It's hard to choose. So there's a question about today's QLD chart, wondering if that's a good example of your concept, and if so, would you always wait for a pullback before shorting, and what is the reason for pullbacks?
Look at today's QLD chart, and I could certainly do that. One thing with the questions, too, before I forget, if anybody has questions beyond our time here today, you can always send an email to me. My email address is there, samseiden@tradingacademy.com. And I'll be sure to get back to those. And with a question like that, if you send that in an email, I could probably I could take a look at the chart, and it'd probably be more appropriate to answer it that way. But what we're looking for in any of these markets is when we revisit the origin of a strong move in price. and we want to make sure that that level has not been touched or hit too many times. We want to make sure there's still a lot of supply or demand there. It's all about finding those pockets of orders.
Great. Another question is about how you draw your zone lines. Do you draw them from the bottom or top of the real bodies only, and not the top of the wicks on the candlestick charts?
We do have a very mechanical way of doing it. But to kind of give you the general yet very important answer, you want to make sure that you have the majority of trading activity in between your two lines. And that's because when price is coming, let's say you have a demand level, and you've wrapped your lines around all the majority of the trading activity in that demand level, that ensures that when you buy, you are buying from a seller who's making a very big mistake. In other words, they are selling right into the meat of that demand. So that's what you want to focus on with those lines. And the reason we create a zone is because in that example, we can buy from someone who's selling right into the meat of the demand, and by putting our protective sell stop below that area, we're giving ourselves the best chance in the trade, and the stop is usually very small. Of course, we always adjust our position size to make sure we're never losing more than we're willing to risk.
There's a question about how many pips should the supply or demand zone cover? Is there a rule on that?
There's no the rule on that is going to be more the rule for you personally. If you are more of an active trader, you're probably going to be looking for opportunities where you're risking maybe 10 to 20 pips to make where your profit margin is at least 50 to 100 or more pips. If you're a swing trader in Forex, you're probably regularly going to be risking maybe 20 to 30 pips in that range to make 90, 100 to a few hundred pips. We recently had a really nice trade in the British pound. The risk was, I think, 30 pips, but the trade went on for almost a 400 pip gain. So it all depends on what kind of risk reward you're looking for. It all depends on the time frames you're trading in. Are you a very short-term active trader? Whether you risk 10 to make 20 or 100 to make 200, that's really personal preference. The opportunities are all over the place.
There's a question on placing stop losses. He wants to know how many pips above or below the base should they place their stop losses.
That's you can be really tight on that. I know for you could just be really tight. I mean, I would go your best levels. The key is to understand, have the tools to identify your best turning points. Out of 10 levels that I'll find on a chart, typically I'm only taking maybe 3 of them. We have a very mechanical way of assessing which levels we want to take and which ones we don't. We run through this little odds enhancers checklist. I gave you 1 or 2 of those things today when we talked about how prices left the level. Did they leave a level in strong fashion? Did they leave in weak fashion? Is there a significant profit margin? Those are 2 of the few on that checklist. We didn't go through the whole checklist today, the odds enhancers, but the higher the probability to trade, meaning the better the level, the tighter you keep that stop. And honestly, I always want to keep my stops real tight. I just don't want to take levels that are not significant. You want to take high quality and high probability levels. And when you do that consistently, I would say, just pennies outside the level if it's a stock, maybe a point at most if it's the S&P futures, and just a handful of pips if you're talking the currencies. And that is not time frame specific.
Okay. We have a question about how far back do you look to establish the buy-sell zones?
That's an excellent question, and the real answer is as far as you have to. Most of the time, it's just going to be a few days, if not a day. But if you're making if the market's making a new, say, 3-month high, well, you're going to have to look back at least 3 months to find your nearest supply level. And those levels, a lot of people will say, well, a level 3 years ago, how relevant is that today? Well, if you're hitting a level 3 years ago that has not been hit since prices left that level, guess what? That means you are trading way out in an extreme, and that's why those levels from far back are usually pretty good. So the answer is, however far back you have to look to find that quality, fresh demand or supply level.
Great. Is there a rule for your target exit price? Can you review that?
Yeah, absolutely. If you're buying at supply, you want to find your nearest area of demand, and that's typically going to be your first target. So therefore, you want to, if you're risking maybe, I don't know, 3 points in a 10-year note futures, if you're risking maybe 5 ticks in a 10-year note futures trade, I'm trying to cross all markets here. If you're risking 5 ticks there, you probably want to look for opportunities where your opposing levels at least 15 ticks away, right? Things like that. So find the opportunities where your risk reward is at least 3 to 1, if not more, to that first target, which is that opposing level.
Okay. We have a question on clarifying the demand a little bit. He's asking, if demand is strong on the left of the chart, why does it still exist on the right?
We are just witnessing every day, real time supply and demand coming into these levels. We take these levels and pay attention to them when they are fresh. Once they are hit and then eventually traded through, they are dead, and we go down the supply-demand curve or up the supply-demand curve to find our next set of levels. And honestly, again, time is irrelevant. That's a key thing that people have such a hard time with is really just eliminating time from the whole equation.
Do you look at volume at all with this kind of trade?
Another great question. I don't pay too much attention to volume, and here's why. It's because if you look at the way volume is always talked about and written about, everybody's looking for the areas on the market in the chart where there was a lot of volume, where climactic volume has taken place. Big volume areas to take their positions at. Well, again, just because a lot of the books say to do that doesn't mean it's real. Just hear the simple logic, and don't take my word for it. Just use your simple logic filter there. Consider this: in any market, prices spend most of their time at or near equilibrium, which means that most of the volume and most of the candles on your screen are going to be at or near equilibrium. But is there trading opportunity at equilibrium? No, especially not the trading opportunity we're looking for. We want to enter positions far out at the extremes where your supply and demand levels are greatest. But the further away from equilibrium you get and out to the key supply and demand levels, the further out you go on the supply-demand curve, the less volume you get at your turning points, right? It's not that what you have to understand is that's where the most potential volume is. That's where the most willing buyers and sellers are. But because supply and demand is so out of balance out there, you get very few trades, which means very few candles, which means very low volume. But that's where we want to enter our positions. So volume can be a little misleading sometimes. We certainly get into that. We have a whole session where we talk about that, but kind of want to give you the basics of it there.
Okay. We have a quick question on, do you use limit or market orders?
I'm usually using limit orders, just because whether it's a day trade